Well, on that note, Michael Rankin, Senior Market Strategist for the NYSE, joins me now in studio with more. Michael, great to have you this morning.
Thanks for having me.
Yeah, let's talk about this market and where we stand amid this shutdown. Traders seem to be not too concerned about it. Why is that?
Yeah, so I think in general, right, markets tend to look past these sorts of shutdowns. There's this expectation that they tend to not last particularly long. Now, in this one in particular, we don't necessarily have like a debt ceiling overhang, which kind of puts a finite point on it. But it does seem that the two sides, there's this expectation that they'll come to some agreement on some of the healthcare issues, and we'll kind of get out of this without it carrying on too long. Now, the question becomes, if it does start to carry on longer, that's where things can get a little more concerning, where you could have kind of a little more of an economic impact. But in general, a couple weeks, markets tend to look past that. We did see a little bit of a shift away from some U.S. kind of oriented assets earlier this week, right? That seemed to spark a rally in gold on Monday, which is kind of held up into crypto assets, right? So kind of that TradFi into DeFi, right? We've seen the international markets outperforming a little bit this week as well.
Yeah, so where do we go from here? The government technically is still shut down. We don't have the jobs report out today, but we do have that Fed meeting on tap later this month.
Yeah, so that's the kind of the most interesting piece of this from a market perspective at the moment, right? Is that we have today's supposed to be Jobs Friday, but it's a jobless Friday, right? Because we don't have today's non-farm payroll report, right? That does make things a little more difficult because we're potentially at this kind of turning point, kind of this fulcrum point with the economy where we've seen a slowing in economic data, and now you have kind of markets and policymakers are all kind of flying blind, right? Because we're not going to we're not going to see the non-farm payrolls data, we're not going to see that weekly claims data, it's likely we're not going to see the inflation data, in the coming weeks as well, and that's going to push things back. What I think that does from a Fed perspective, though, is it's going to, it kind of solidifies the idea that they're going to probably be cutting in that October timeframe, right? Because if you've shifted your focus, to the labor market side of things, right, and you were saying you were concerned about that, and now we're not able to see if there's any improvement on that front, right? They're going to probably move forward with that 25 basis point cut, despite the fact that you're hearing a lot of the commentary from Fed officials, which is not necessarily nearly as dovish as market expectations.
Interesting. So technology shares have benefited. Recently, we've seen definitely the AI boom, and even in the private markets, OpenAI valued at $500 billion based on a secondary share sale that we learned about yesterday. What more can you share about the strength behind that trade?
Yeah, that trade is been a runaway train for quite some time now, right? And now you're really getting into this point where we're starting to see very large M&A transactions that are kind of happening in the space, right? You had, there's rumors that AES is going to be bought for $40 billion. There's a rumor that Aligned is a potential $40 billion deal by BlackRock for Aligned, which is a data center kind of building company, management company. And then you continue to see these partnership deals from OpenAI. Now you're getting into this kind of period of time where it's getting a little bit more dicey, right? Where you're starting to kind of bring back memories of kind of the late 1990s, where you continue to have these very large deal announcements. You're having these deal announcements, and that news flow continues to drive, kind of the stocks, kind of higher, right? So there's starting to be a little bit more concern. And then the other piece of that is that you've now started to shift away from a lot of these companies just financing all of this infrastructure build with cash on hand. You're starting to see kind of larger, debt raises and tapping capital markets to raise, debt to finance some of these transactions, right? So, markets are starting to get a little bit more cautious in looking at that. You're not seeing it in the equities, but it's definitely become a talking point.
Interesting. So, of course, IPOs impacted to some extent, perhaps, by this shutdown. We know that the SEC is part of the government, right? So certainly an agency that could be impacted here. What does this mean for capital markets? Yeah, so
that's a great point, right? And that is, from a market perspective, that is one of the things that can potentially slow down, kind of that IPO pipeline, right? As the regulatory process gets drawn out, that will impact potentially kind of IPOs. It also impacts kind of some of the things kind of around kind of crypto and things of that nature, right? As you've been kind of trying to move forward on the regulatory front, and that kind of slows that process down. Look, in terms of the IPO market, right? There's clearly strong demand, right, and from the kind of the investment community, kind of to bring these companies to market. We've continued to see deals, priced, well, upsized, and kind of trading well on the back end, right? So, there's still that healthy demand there. It just may kind of push things out from a timing perspective.
What else are you watching in this market? I can't believe it's already the start of the fourth quarter, Michael.
Yeah, I mean,
it's going to be here before we know it at the end of the year.
It's really, kind of crazy that we're kind of into Q4. One of the really interesting things that I kind of took a little time to look at recently is that, we all talked about kind of this negative seasonality in that August and September time period, right? And that didn't show up, right? You had equity markets move higher kind of during that time period. You had a strong September, which is, historically one of the worst months. So what I did is kind of went back and looked at markets, kind of post 1970. What does the return profile look like in years where you actually buck that negative seasonal trend, right? And when you look at that, Q4 does tend to be underperform kind of years where markets were down in that time period. But what the data kind of tells you is that the outperformance in those down years is really just kind of a catch up, kind of a reclaim of some of the lost ground. If you look at markets from kind of the end of July through year end, years where markets are positive in that August-September time frame, right? The median return profile over the last 50 years of those 30 years, or 30 of those 50 years, is just about 7%, right? So, tells you that we're in for a decent kind of Q4 here, kind of historically from that perspective. But we've seen kind of a lot of that move, and I think there's some consolidation that might have to happen.
Some consolidation. We'll be watching that. Indeed, data on hold does make the Fed's job a little bit trickier, as you referenced there.
Yes.
But based on the latest inflation read that we got, it seems like what we know now, it's all about cementing a rate cut when they meet in October.
It does sort of seem that way, right? And then I think the other thing that you can kind of really start to pay attention to is we're getting into earnings season in about a week and a half, where it really starts to kick up. And you've started to hear some companies kind of continue and to talk about kind of the impacts of tariffs. If you look at the ISM surveyed kind of commentary, there still continues to be a lot of talk about kind of the impact of those tariffs. And you're starting, you saw Nike earlier this week, RPM this week, and kind of Caterpillar a couple weeks ago, all highlight that kind of the impact of tariffs on their bottom line is starting to kind of hurt in a bigger way. So that's something we're going to have to kind of pay attention to in the Q4 earnings season.
Michael Renking, Senior Market Strategist here at the Stock Exchange. Michael, thank you as always.
Thanks for having me.
Yep.